Welcome back to the Working Thesis Market Daily. This is Thursday, June 18th, 2026. I'm Nova.
And I'm Onyx. Markets are closed Friday for Juneteenth, so this is the setup heading into the long weekend and the next regular session on Monday, June 22nd.
Quick note, this is public market commentary, not investment advice, not a recommendation, and not a forecast. Individual company moves are stated as facts. The thesis reads are probabilistic and meant to be revised when evidence changes.
Today had two big stories. First, chips ripped, led by memory and storage. Second, the structural debate got sharper. Frontier provider usage may be peaking, but that is not the same as AI demand slowing. And on the macro side, is Warsh just talking tough, or is a 2026 hike risk actually live?
The index tape looked like a post-FOMC relief bounce. QQQ rose 2.5%, SPY gained 1%, IWM small caps rose 2%, and DIA barely moved, up 0.1%. The Dow lagged because this was mostly a tech and chip session.
Volatility cooled quickly. VIX fell 11.1% to 16.4. That matters because Wednesday was the Warsh shock. Thursday was the market deciding it could still buy parts of the tape.
But the dollar did not back off. DXY rose again to 101.08, its fourth straight day higher. The 10-year yield was almost unchanged around 4.45%.
That combination is important. Equities bounced, but the dollar stayed firm. So the aftershock from Warsh did not disappear. It just moved from equities into the dollar and gold channel.
The sector leadership was very clear. SWXX rose 6.6%, and SMH rose 5.8%. XLK, the broad tech ETF, gained 3%. Utilities were steady, up 0.7%.
The laggards tell the other side. Financials fell 0.9%, energy fell 1.6% with oil softer, and GDX gold miners fell 2.2%. Gold miners were down for a fourth straight day as the dollar kept grinding higher.
The chip move was not generic. It was memory and storage leadership. Western Digital up 4.6%, Seagate up 3.4%, Intel up 3.5%, Dell up 3.8%, Broadcom up 4.3%, and Micron up 2.2%.
The reported drivers were Apple memory price pressure and Intel-related U.S. chip manufacturing headlines. The individual stock facts are simple. Memory and storage were the leadership group, and the SOX index is now up sharply year to date. The broader thesis question is whether AI demand is squeezing memory supply in a structural way.
The first structural debate is AI token demand. Some creators and strategists have argued that high-end token usage at expensive frontier providers may have rolled over. The report's counterpoint is stronger than just a rebuttal. Aggregate token demand is still accelerating.
Public OpenRouter-style usage data supports the idea that total model usage remains high, with weekly token volume around the high 20s to low 30s trillion range in recent June readings. The source report cites 28.9 trillion tokens a week, up 7.4% week over week, with 5 straight weeks of growth.
That distinction matters. A peak at expensive frontier providers is not the same as a peak in AI demand. It can mean two healthier things. First, optimization, where batching, quantization, caching, and better routing reduce wasted compute per task. Second, diversification, where workloads shift toward open-source Chinese, self-hosted, or local models.
The report's example is the model selection gap. Premium frontier models can remain best for hard tasks, but alternative models may win routine or long-tail workloads. The point is not that AI use is fading. The point is that inference is becoming more segmented and more intelligently routed.
Said another way, AI demand is broadening, not disappearing. The frontier layer still matters, but more activity may be split across frontier clouds, open models, self-hosted models, and local inference.
The public thesis implication is constructive. More efficient routing and model selection can unlock more use cases. If useful models can be deployed across more form factors and more budgets, more workflows become economical, not fewer.
One sub-branch is AI PCs and local inference. The related public names are AMD, Dell, HP, Qualcomm, and Intel. AMD Ryzen AI, Intel Core Ultra, Qualcomm's PC chips, and enterprise AI PCs from Dell and HP all sit in that local inference conversation.
Small language models also matter. Phi, Gemma, Llama-class smaller models, and Chinese open-weight models can run closer to the user, which can lower latency, reduce dependence on remote APIs, and improve privacy for some workloads.
But there is a caveat. If frontier token usage and GPU rental economics keep softening, investors may start questioning the hyperscaler capex cycle. That would not mean AI demand is weak. It would mean some economics are shifting away from the most expensive compute layer.
So the key question into Q2 earnings is not just, is AI being used? It is, where is AI being used and who captures the economics?
The second structural debate is Warsh. The report frames a faster pivot Fed as a live risk. Warsh may not be ideologically hawkish forever, but he may move faster than Powell when the data changes.
Public rate pricing sources are not perfectly aligned with the report's more aggressive September hike read. What is easier to verify is the direction. The June Fed communication was hawkish, the dollar rose, 2-year yields reacted, and markets pushed back against the old easy-cut narrative.
That means the clean public framing is, September hike risk moved from dismissible to live, but the exact probability depends on the pricing source and will move with inflation and Fed pushback.
Warsh's important phrases were about decisively bringing inflation back to 2%, moving faster when the world changes, and letting markets react to data. That style makes the Fed less predictable, and uncertainty itself can tighten financial conditions.
Equities bounced Thursday, but bonds and the dollar were still taking Warsh seriously. That is the tension. Stocks wanted to call the hawkish bluff, while the dollar did not fully agree.
Gold is where the framework got another clean test. DXY moved above 101, gold was down about 5% for the week, and GDX miners fell again.
This fits the refined Thesis 3 mechanism. A crisis dollar move and a Fed credibility dollar move are not the same. Earlier geopolitical dollar noise did not break gold, but a real yield or Fed-driven dollar bid can pressure gold and miners.
The structural gold thesis is not automatically broken by 1 week. Debt math did not change. But the trading pressure is real while the dollar remains bid and markets price a more hawkish Fed path.
For public content, the takeaway is not an instruction. It is a driver map. If DXY keeps rising on Fed credibility, gold miners can stay under pressure. If the dollar peaks, the structural gold debate can reopen from a different setup. The geopolitical and macro layer was disinflationary. Oil stayed soft, and the report cites an IA view that 2027 could see meaningful oversupply. Crude weakness matters because lower energy prices can soften inflation pressure.
That is one reason the Warsh debate is complicated. A hawkish Fed message can lift the dollar, but lower oil can argue against sustained inflation pressure. The market has to decide which channel dominates.
There was also a mechanical flow point. JP Morgan-style quarter-end rebalancing estimates suggest large institutional equity selling into month-end, with some rotation toward bonds. That is not a thesis by itself, but it can create short-term supply overhang.
SpaceX was also in the macro financing thread, reportedly preparing a large investment-grade bond to refinance prior bridge financing. That keeps the broader AI and private market financing story alive, though it is separate from the day's index move.
Thesis 1 AI, supported but changing shape. Token demand does not look dead. It looks like frontier provider usage can peak while routing gets smarter and value diversifies across frontier, open, Chinese, self-hosted and local layers. The watch item is hyperscaler capex discipline.
Thesis 2, incumbents adapt, still mixed. If workloads get routed across frontier, cheap, and local models, enterprise software companies need orchestration, governance, and distribution advantages to capture value.
Thesis 3, sovereign debt and gold, structurally intact but tactically pressured. The Fed-driven dollar bid is the stress scenario, and it is live.
Thesis 4, energy and physical constraints, still relevant. Memory shortages, AI PCs, and local inference do not remove the power constraint. They broaden where compute happens.
Thesis 5, pragmatic multipolarity, reinforced. Chinese models gaining usage share, U.S. chip policy, Apple memory pressure, Intel manufacturing headlines, and TSMC packaging all point to a fragmented AI supply chain.
The weekend homework is two debates. First, if frontier usage peaks but aggregate demand keeps growing, which parts of the stack benefit? Frontier models, alternative model providers, AI PCs, memory, networking, or edge hardware.
Second, if Warsh is faster and less guided than Powell, does the dollar keep rising, or does lower oil and softer data eventually call the hawkish bluff?
For Monday, watch whether chip leadership continues after the memory storage surge. Watch DXY around the 101 area. Watch gold miners for whether dollar pressure is still biting. And watch whether QQQ's bounce has breadth, or is just a post-FOMC relief move.
That's the wrap for Thursday. Framework notes only, not recommendations. We'll revise if the evidence changes.